Have you ever wondered how two similar exact portfolios could be met with two absolutely different results? Have you ever wanted to really know about passive management versus active management and what the difference is? Have you ever, if you've got a pension, have you ever wondered whether you should take the lump sum or take the guaranteed payout? Have you ever wondered how to structure income when you're in retirement? I'm going to show you two different ways we can do that today, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, welcome back. Listen, in this segment, I want to have a little bit of fun with you, okay? I'm going to take two brothers. They're going to retire at the same age. All right, and they're going to start off with the same amount of money. Let's say $500,000. They're going to take 5% out each month for each year, I should say, for income. All right, so that'd be about $25,000 per year. All right, now I'm going to add they're going to be invested exactly the same to the penny. All right, and I'll add this: they're going to be in this. They're going to have the same amount of tax-qualified accounts, meaning the same mix of IRA, Roth IRA, maybe non-retirement money. All right, again, invested exactly the same way in all those accounts, taking income from the same account. All right, they got. Do you see any difference here? All right, now at the end of 10 years, the one brother, he has just a little over $1.3 million. Not bad, right? Starts off with $500,000. Just about triples his money while he was taking income from it each year. Not bad. The second brother, all right, at the end of 10 years, taking this same amount out each year, all right, starting off with the same amount, invested exactly the same way, at the end of 10 years, his account is worth just a little over $200,000. Folks, what happened? What happened? How did the one brother just about triple his money and the other one lost better than half its value during that period of time? What happened? Now I'm going to give you a moment to just kind of think about that, right? Remember, they were invested exactly the same way, had the same amount of tax-qualified accounts, taking income from the exact same accounts, and let's add this, maybe they're taken exactly in the same day. What happened? Folks, this is what happened. The only difference between those two portfolios, or those two brothers, was when they retired. The first brother retired in 1990. All right, and guess what he got for 10 years? Nothing but an up market. The second brother retired in 2000, and look what he got. He got 911, right? Market dropped to half its value from 2000 to 2002. And then again in 2008, lost half its value. The only difference between those two brothers or those two portfolios was simply when they retired. So I pose this back to you. If you're somebody that's near retirement and in retirement, you know, how willing are you to gamble what you have in the hopes that you might get the market that the one brother got, but what if you got the market that the other brother got? I encourage you, if that's a concern for you because you're in that situation, near retirement or in retirement, then give us a call, because that's not something you want to be gambling with. You want to be very careful with. So give us a call.
Today's retirement challenges can be mastered. Knowledge is power, because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors, specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Wednesday, October 23rd at Big Buck Brewery in Gaylord. Tuesday, October 29th at Lakeside Charlie's in Cadillac. or Wednesday, October 30th at Boone's Long Lake Inn in Traverse City. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated Financial Decisions. Call 888-608-5825 today.
Hi, welcome back. Listen, in this segment, I want to talk to you about what is called passive investing versus what we call active management. Two different things, folks, and it's something you're going to want to be very, very aware of. First of all, one thing that's out there that's it's growing in popularity is what we call ETFs, or exchange traded funds. Okay, like these, like a bucket of securities. All right, and basically once you put all those securities in that bucket bucket closes. Okay, there's no longer any trading happening on it. It's basically like an index. You're just basically tracking that bucket of securities. That's what an exchange traded fund is. Now, they trade on the New York Stock Exchange just like a stock does. They're highly liquid because you can buy and sell them right on the exchange. But basically it's passive because there's no trading anymore going on with that account. That bucket, that ETF is going to hold those securities no matter what until you sell it. Okay, so you might find if there's no changes happening, then that's probably leaning more towards, a passive account. The other thing is when you look at a mutual fund, for example, all mutual funds have objectives, okay? Meaning they have an objective to hold certain securities in that fund, in that account. Okay, now unlike an ETF or an exchange traded fund, there's trading going on within that account, okay, based on that objective in the securities they hold. For example, let's say I'm in what I call a large cap mutual fund. That's simply a mutual fund that has to hold large company stocks. That's what its objective is to do. And so that fund manager is going to buy and sell large company stocks within that portfolio. Now, even though that change is happening, you've got some management happening with that. It's somewhat passive in the sense that it's only going to hold those securities that it holds. All right. Now, the key factor to understand when you're dealing with ETFs or mutual funds is understanding what they hold and what they're going to do when market conditions change. Because if all you're holding is certain sectors or certain asset classes and you don't have effective diversification, then it's going to be very passive because it's not going to change up a whole lot. Okay? Now, active management, these are going to be fund managers or portfolios that are actually going to change with the market conditions. They might not be held to objectively hold any particular assets within their portfolio. If they see interest rates rising and bond values maybe going down, then guess what? They can change that up. Maybe they can lower their exposure accordingly. All right? But what you want, when market conditions get such that, especially as we approach recessionary times, you're going to want to be careful what kind of account you're in, because you may find it necessary to maybe be more in accounts that are active that can change up rather than be passive. So if this is a concern for you, something that you want to understand more about, then I encourage you, give us a call because we'll gladly take a look at that for you.
Well, really good information there, Larry. And guys, I find it interesting when we're sitting down and talking about this active versus passive management. It sort of catches viewers just like you sort of off guard as far as what is that? Because a lot of times you might be sitting in your 401k, 403b, 457 plan, and you're used to that menu of options, those different mutual funds basically that you have to choose from. But when it comes to retirement planning and it opens up all of these different options for you, and specifically when it comes to then structuring a portfolio to generate an income stream, how much different that can be than just your typical growth and accumulation phase where you're putting money aside towards your retirement and ultimately wanting to then start an income stream. And that's where it takes a whole different world, I guess, when we look at that, right, Art?
Absolutely, John. You know, folks have these 401k plans they may have had for 20, 30, 40 years, and they've had some menu of options in there, something that they either they've been told they should have, or something they've picked on their own. And it's worked well recently, probably because the markets have been well, but they're coming up on retirement the next few years, and how unbeknownst to them, things are going to change in their lives. You know, how that's structured really is critical this time. You know, John, you and I just did a presentation for a group of employees at a company here, and it was amazing how well many of them have done saving, but yet how little planning they've done for retirement. Right. You know, I think back, guys, that we've told this story before, but, you know, there was a couple that come and seen us back in 2007. They were getting ready to retire, and he was in the auto industry down in Southeast Michigan, and the market crashed on him. You know, 08 come around, and later come to us 3-4 years ago and talked about that impact on him and how he actually ended up working for another 5 years to get back what he had lost. And it wasn't the money, and it's always interesting, he tells us the story, is it was the time. He worked 5 more years than he really wanted to get that balance back to what he thought he needed in a retirement. It's a critical time to be planning for retirement. If you're really within 5 years or so of retirement, now is the time to plan.
Yeah, this bull run's been going for, you know, better than 10 years now, and you know, we try to tell people, you know, financials are cyclical. You know, you have periods of time where they're in expansion, and then you go into contraction. Recession's coming. It's just a matter of when. This is the time where active management can should be playing a bigger role. So if that's you, if you just want to know how you're invested, how you could be best invested, then give us a call. We'd be glad to sit down with you, and no cost, no obligation, just to kind of see how you might be better positioned. Hi, welcome back. Listen, in this segment, I want to talk to you about pension buyouts. Now, I know a lot of us don't have pensions. You know, it seems like more and more people coming into our office today have little or no pension at all. But if you're fortunate enough to be that person who has a pension, you know that when you retire, you're gonna have some options. You're gonna have some things that you're gonna have to consider. One is, a lot of these pensions will offer you a lump sum payout, okay, or a guaranteed income for the rest of your life, and you have to pick between the two. You're going to want to seek somebody to help you with this, because there's some things that you have to consider. They'll usually change the payout options based on survivor benefits. For example, if you want it all to go to your spouse in case something happens to you, then that would be 100% survivor benefit, maybe half, and they'll change the payout accordingly. So that's a high consideration you're going to want to take a look at. You're also going to want to consider the credit qualityness of the company or government that's paying the payout. It may be a great payout, and you might want to have the guaranteed income, but if you have to worry about that company going bankrupt or that government possibly going bankrupt down the road, you're going to want to maybe have the lump sum and have it now. Okay, so that's going to have to be of high consideration for you. The other thing you want to consider is liquidity. Do I have enough money set aside for emergencies? If I'm just getting a guaranteed payout from a pension and then I've got Social Security, do I have enough money to fall back on for emergencies and things that I'm going to need money for down the road? So there's a lot of considerations that you want to take into account when you're looking at that lump sum payout or that pension. So I encourage you, if that's somebody like you, just give us a call. Be glad to look at all those things for you and see if it makes sense for you.
You know, Larry, that's really interesting timing on this pension here. I mean, it's amazing how some things kind of come and go in our industry. You know, a few years ago, guys, it seemed like everybody had a pension buyout we were dealing with for a while. Then nobody talked about pensions anymore. But now it seems interesting. There's a lot of places, even locally here in northern Michigan, that we're seeing some folks either with company acquisitions or mergers, stuff like that, where they're getting these pension buyout offers in the mail. I just sat down with a great couple the other day and ran through all the numbers, and they had a very favorable payout over their life expectancy. Had 100% survivorship built in, but they were adamant about doing the pension buyout, not taking the pension payments because of the beneficiaries. They felt that their life expectancy wasn't great long term, and they wanted their children to maybe benefit from this. And so with the typical payments, their children wouldn't be getting any, but if they put that money in an IRA, there's a chance there'd be some left for them.
Yeah, and it's good timing because just this past week I've had two different couples that have come to me, and they're both happen to be in the energy industry, and they were having these pension buyout offers, and so they asked me, okay, John, what do we do? And so it's running through those numbers to evaluate, do you just take it over just your lifetime, or there's different survivorship options. And I encouraged the husbands in their case that both were offered. I said, guys, a 100% survivorship option would do you pretty well because of the fact that they were ultimately unknown how long they're going to live, but want to make sure that that income's there for not just their lifetime, but also for their wife's lifetime. So again, each scenario is a little bit different, but it's worth evaluating. Yeah.
Guys, we've shared a lot of factors that go into making that decision, whether to take the lump sum or the guaranteed payout. But if you're that person that has been offered that lump sum and you want to know what's best choice for you, give us a call. We'd be glad to sit down and work through that with you. So give us a call. Thanks. Hi, welcome back. Listen, in this segment of Chalk Talk, I want to show you how you might structure a portfolio to get the best results, especially if you're taking income, okay, or you're in retirement. First of all, I want you to take your total savings. Okay, this is everything you have, from IRA money, 401k money, maybe even, that non-retirement money, okay? I want you to take all of that, and then I want you to, number one, segment enough aside for emergencies, okay? That would be your savings account. I've heard some people say, well, that needs to be 3 months income. Others say 6 months, maybe even a year. Doesn't matter. Is whatever amount you feel comfortable with having set aside for any kind of an emergency that might come around. Now, how that money is going to be invested, it's going to be highly liquid, it's going to be highly conservative, right? Because I may need that with a very short notice. The second thing I want you to do is then set aside money and put it in what we call the income bucket, okay? When you're working and you're getting a paycheck every week, maybe every other week, okay, your income needs are being met. And then you've got your savings doing what it's supposed to do, right? Hopefully growing. Well, like in this bucket, to the bucket you need to create to give yourself a steady amount of income that's going to replace that paycheck, especially when you get to retirement. All right? Now, once I've set aside money for that, then I've got what I call the conservative growth bucket. Okay, this is money that you want to set aside for all those intermediate term needs, okay? Maybe it's a car repair, maybe it's a car replacement, all right? Maybe it's a home improvements, home repair. Maybe it's those extra vacations we want to take, those ones that might be on our bucket list, right? Maybe it's some of those healthcare costs we want to set aside for. Whatever it might be, that's going to be invested in a certain way as well, because I might need it in your term, or I don't want it having a lot of volatility, right? Now, if I've set aside for my emergencies, I've set aside for my income, and maybe anything that might come up in interim, then everything else can pretty much go in that growth bucket. All right, that's traditionally how we probably had things invested while we were working. Okay, that can have a little bit of volatility associated with it because I don't need it for income, I don't need it for emergencies, okay, but I do want it hopefully to grow. Okay, I want it to grow because as this bucket, I use this bucket, I want some of this maybe to replace and get back into that bucket. So folks, if you use what we call the bucket approach and you structure it accordingly, the kind of results you're going to have are going to be much, much better in retirement. If this is something you want to see for yourself, then I encourage you, give us a call. We'd be glad to run through this with you and how it might be appropriate for you. Where are all your assets going to go when you pass away? Do they know where to go? Who's going to make the financial decisions for you when you can't make them for yourself? Who's going to make those healthcare decisions for you when you can't make them for yourself? Listen, these are all issues that can be addressed in any good estate plan. So I encourage you, give us a call, let us come alongside of you and put the proper processes in place to make sure you have a good estate plan. Give us a call. Hi, welcome back. Listen, in this segment of Chalk Talk, I want to talk to you about what we call the laddered strategy, okay? This is a way in which you can structure a portfolio to get the maximum results, especially if you're taking income in retirement, all right? First of all, what you want to do is segment a certain amount of money aside for just the first 5 years. Okay, so let's say I'm wanting to take 5% from a portfolio. Let's just use that as a general rule. That's going to be basically 25% of my portfolio. Okay, so I segment that aside. Now, because that's short-term in nature, because I need it in the first 5 years, how that's going to be invested is going to be highly conservative and very liquid, right? I might, in this environment, I might only get 1% on my money there, right? The second thing I want to do is then set enough aside for what we call the next 5 years after that, or the 6 to 10 years, okay? Now again, if I'm taking 5%, that's going to be another 25% of the portfolio. Now, because I don't need this in the first 5 years, I've got 5 years in which it can grow and then take income. How that's going to be invested is probably going to be, still conservative, but a little bit more different than what I had in the first 5 years, okay? In this environment, maybe I'm only getting 2 to 3%, okay, on my money. Now, if I've structured it this way, I've got half my portfolio, right? 25% in this bucket, 25% in this bucket, and so I've got half my portfolio very conservatively invested for my income in the next 10 years. Now, everything else can go into that 10-year plus bucket. Okay, now because I don't need that for 10 years, I can have it probably in a traditional growth bucket, which means it's probably taking on a little bit more volatility, but because I have time, I'm going to get a little bit more growth out of it, right? Now for this example, I said let's just use 7%. Let's say it's in that bucket, I'm getting 7%. Using the rule of 72, which is if I take 72, divide by any rate of return, it's going to tell me how often my money doubles. So if I take 72 divided by 7, it means my money is going to basically double in about 10 years. So if I use this money for the first 5 years, it runs out. And then from 6 to 10 years, I use the rest of that money. Okay, so then it runs out. And the rest of it's in this bucket, growing by 7%. I already know that it's going to pretty much double in that 10-year period. All right, then all I have to do is turn around and take that money, take 25% of it, put it back here for the next 5 years, then another 25% here, and again, doing that every 10 years. Can you see how this could maybe make your outcome a little bit better, especially when you're taking income? I encourage you, if this is something you want to take a closer look at, then give us a call. We'd be glad to go over this with you.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, Financial Advisors, specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Wednesday, October 23rd at Big Buck Brewery in Gaylord. Tuesday, October 29th at Lakeside Charlie's in Cadillac, or Wednesday, October 30th at Boone's Long Lake Inn in Traverse City. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated Financial Decisions. Call 888-608-5825 today.
Yeah, guys, I hope our audience gathers, if you get anything out of those last two segments, the resounding theme is, segregating money aside for income. Too many people put everything all in one basket and then they try to extrapolate their income from that. But if it's not invested appropriately, there could be some danger in that.
Yeah, absolutely. And I think that's the key. I mean, so many folks we see don't have a plan. Either A, they're coming in and they have this bucket of money that it's still there the way they've been invested for 30 years, and they don't know what they can take out, so they just don't. They're living on less than maybe they could be because they're afraid to spend it. They don't know what they can. Or, unfortunately, the other circumstance comes around where they're spending too much because they got this lump sum of money. It seems like a lot of money, but they don't plan over the next 30, 40 years that this has to last them.
Yeah, nobody wants that spending too much type of plan, but that's where it comes back to ultimately setting a plan, and it takes time to walk through that with you, and I appreciate where you created that visual with the buckets and with the laddering, and so that's something. I'm a visual learner, and so we like to sit down with folks just like you to better understand sort of where you're at, what you're trying to accomplish, and then map out an income plan so that okay, over the next 20, 30 years, here's what I can count on as a structured income plan. And along with that, it's not just, okay, we're just going to pull this dollar amount, but then understanding what the tax implications of that can be. And that's what ultimately can cause some major headaches if you don't do that properly. So we encourage you, give us a call. We'd love the opportunity to sit down with you for no cost, no obligation, second opinion, and just have a conversation about where you're at in retirement or leading up to retirement, and then start working with you on laying out that income plan, because that is going to be vital for you in your retirement. So we hope to hear from you sometime soon, and thanks again for tuning in to Retiring Well.